Today we are looking at Exxon Mobil Corp, ticker symbol XOM, currently trading at about $108 a share, and since the start of the year it is up almost 5%. What we're going to be doing is looking at my automated stock valuation spreadsheet, looking at the latest company financials, then giving a fair value of the company using discounted free cash flow model, the comparable company model, and finally the Ben Graham formula for intrinsic value to see if this stock is a buy or a sell. So let's quickly have a look at Exxon and what it's been doing over the past few years. Since the bottom of COVID, this has been a consistent buy on my channel, and it was about $32 at the very bottom and is up almost 228% since that time. That's a massive increase, better than some of its contemporaries, which we'll go through in a minute. But yes, over the last year, pretty flat. If we were to compare this with the market, SPY over that time, the market is up around about 32% in that year, whereas Exxon has been pretty flat year to date, pretty close, 8 and 5%. Now, one of the things that people like about the stock is the 3.53 dividend yield, which I'll be talking about, and is that safe, and we'll be getting paid that. So let's have a look at my automated valuation spreadsheet. If you put in the ticker XOM, this will load all the data, and then we'll just have a quick look at everything here. So as you can see, $107 a share, market cap, let me just make this a little bit bigger, sorry. Market cap of around about 426 billion, P ratio of 12, which is lower than the market average, which is around about 27. So that is a very good start. Earnings per share of $8.88 and a beta of 0.96, which means it moves about as volatile as the market. It moves in about the same way. Shares 4 billion, and a target price according to analysts is the $125 a share. So that is very interesting. Let's see what we think on that, about that. Dividend yield, as I said, around about 3.5%, which is $3.78 a share. In terms of a total dividend, that is 15 billion. Payout ratio and free cash flow payout ratio is about the same. So yeah, that means that it's a pretty safe dividend. Ex-dividend date hasn't been announced yet, but the last one was in February. So if you did buy your shares before, then you will be being paid around about today, actually. So it will probably be in 3 months from now, in about May or June will be the next time. So buy your shares then before, if you want to have them. So let's have a look at the revenue here, and firstly we'll look at this chart. This is the annual revenue of Exxon over the last, since 2009, and obviously not as high as it was back in 2011, 2012, down from 2022, but has been increasing overall from when it was at its lowest, pretty much over the last 20 years back in 2020. So it is trending in the correct direction, which is what we want to see. Next, we're going to have a look at the net income. This is obviously the profit, earnings, and this is cost of sales minus, sales minus cost of everything else, goods, selling, admin expenses, operating expenses, depreciation, taxes, interest, and other expenses. And yes, they're a very profitable company, 36 billion, down from the prior year of 2022. This was a pretty good year for them, but as you can see, once again, we are trending in the right direction over the last 5 to 10 years. Next, you want to look at shares outstanding. Why is this? Well, you want to see if it is decreasing or flat. This is the way that companies can reward shareholders by buying back their shares. And Exxon have consistently, apart from some issuing here from 2017 to 2021, but they are buying back their shares again. And this is the first time they've been below 4 billion in shares. So this is good to see. Slow, steady buying back, rewarding the shareholders. Assets versus liabilities. We want assets and liabilities to be obviously quite close, and this has actually increased over the last few years. You can see there's more than half, 100 billion compared to 164. And if we look at the ratios in prior years, obviously was a lot greater differences, but now it is increasing in the right way. And finally, free cash flow. What is free cash flow? Cash from operations, operating activities minus capex. And the more free cash flow the company has, the more it can allocate dividends, pay down debt, growth, and buy back shares. And we can see currently it's about 33 billion, down from 22 and 2021. But you can see this free cash flow does shoot all over the place. But from 2015, it is increasing. which is what we want to see. Down, obviously, in the prior years, but still, overall, it is going up. Dividend history, this is something we can see about Exxon. This is dividends going back to 2001, and basically we can see steady increase in growth, which for dividend investors is always great to see. Let's have a look at my automated valuation sheet again. Check out the Patreon. Obviously, links are in the description, but let's get into it. So the first thing we're looking at is free cash flow ratio. This is our discount free cash flow model, which is creating a estimate based on future free cash flows. So based on the averages, you can see this is currently a $40 stock. Looking at this initially, you can see that the free cash flow ratios it's generated are pretty bad. This is because bad numbers in 21 and 22. We can see more consistently we're at about 93%. If we would take an average of this, it would be slightly higher, 96%. So let's go on the higher side. Let's take those two in averages. And all right, that is an $82 stock straight away. Now let's have a look at revenue growth rate. Revenue is down obviously this year, so let's just say that 9% is that fair enough. They can grow at about that. Net income margins, once again, this is an incorrect number here because of the bad years due to COVID. Average of about 10%, and that puts it at $136 stock. So let's have a look at these revenue growth rates. Let's just say they'll be able to be flat for a few years. I would put it down to about $96 stock. So as long as they keep on growing, which according to analysts, they are expecting, what are they expecting? Well, they're actually expecting negative growth, but over the past 5 years, it grew 40%. Next year, 7%. So let's put in a similar amount. Let's say that they grow at about 6% over the next few years. $120 stock. So somewhere in the region of $100 to $120. That's good to see. Next, we're looking at the comparable companies model. What this is a way to value a company using competitors and then looking at the metrics. And the metrics that we are looking at is EBITDA, which is earnings, earnings before interest, taxes, depreciation, amortization, net income, and then we EV to revenue, EV to EBITDA, and P. And we want some contemporaries or competitors. So we'll do BP, we will do Chevron, FCX, SVX, I believe. And then finally Shell, which is SEL. Now, if we have a look at the equity values of this company, of these companies, Exxon is the biggest, revenue, one of the biggest, EBITDA, biggest, and net income, the biggest as well. So we want to see lower ratios. That is better. These have very low EV to revenue ratios, and Exxon is at the top, 1.3. So based on these metrics, you can see it's slightly overvalued actually comparing the other ones. PE on the higher side, EV to EBITDA on the higher side, and EV to revenue on the higher side again. So slightly overvalued compared with its competitors. And then finally, we look at the Ben Graham formula for intrinsic value. What is this? Well, this is a way or formula that Ben Graham used to value growth stocks. And what this is looking at the earnings per share, the growth, the PE of a no growth company, the AAA bond yield, and then the current corporate bond yield. So let's just have a look quickly at the current corporate bond yield, obviously very high. Oh, we're very higher again, 5.03. So I'll have to update that again. That's the highest it has been in quite a long time. Well, actually, no, sorry, it was up in there in October, but consistently it's been higher. Basically, got to go back to 2015. So that was we will change that to 5.3%. Now this will obviously lower the price. And let's have a look at the expected growth rate of Exxon. And as we said, it was a minus 10%. So obviously it is not going to like this. -9, yep, negative stock. So what we'll do is we will see the current next year 7.2%. 7.2. That'll put it at about $100, $110 a share. Now, if it was to grow at a similar way over the last 5 years as it did in the next 5 years, that is 40%. Obviously, analysts are not expecting that, but you can see that's the kind of growth. That would be a $300 stock. So obviously, we're expecting on the high side. Basically, if we want to get a good return on our money, we probably needed to grow somewhere in the region of 10 to 15% in the next few years. So actually, despite this being a pretty popular stock because of its high dividend, based on the models, it is probably about fairly valued at the minute, or maybe slightly overvalued. Right, guys, thanks for watching. Please give a like if you enjoyed the video, and I'll catch you guys next time.